Good afternoon, everyone, and welcome to another of our great presentations in the aftermarket hours here at TradeStation. Another of our great webinar presenters is with us today, and that is Fari Hamzei of Hamzei Analytics. Now, his topic today is how to identify high probability option trades. Now, many of you who might be new to options trading could be getting excited now because you're hearing about option trades that are high probability. You might be thinking that option trades usually win and earn money, especially these types. And that would mean that a low probability trade might mean the chances of making money are lower. But is it really that simple? And why would anybody ever enter a low probability trade if there was a high probability trade available? Well, the answers to these trading questions have to be understood before you initiate your next options trade. Professional trader Fari Hamzei, the founder of Hamzei Analytics, is going to help shed some light on this topic for us today. His company is in its 18th year of serving institutional traders, fund managers, and professional traders. Since February 2001, their data has been available to individual traders and investors, providing everyone real-time access to these powerful trading tools. Their mission is to provide valuable insights to advanced traders for analysis of mass behavior in the equity, bonds, and commodity and currency markets. So join me in welcoming Fari Hamzei, the founder of Hamzei Analytics and author of Master Trades: Securities for Superior Returns from Today's Market Traders, as he reveals his routine for options trade selection in two modes. Before we get into the presentation, let's make sure that we run through the legal disclaimers. And remember that our presentation here today is for educational purposes only. All the symbols and all the trading ideas that we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Remember that active trading is not suitable for everybody, and options trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information in the PDF handouts I've made available in the chat panel, particularly the characteristics and risks of standardized options. These items are also available on the TradeStation website. Now, we are recording this presentation today, and it will be available for review on VideoStation if you're a TradeStation user, or on the TradeStation YouTube channel when we get it processed later in the week. Now, there are some audio questions, and the best place to go if you have an audio problem, if you've logged in properly, check that question mark in the upper right-hand corner, and it will run down a few issues or a few things that you could look at. As some of you have already noted, if you log out and log back in, that generally is the big fix. But at any rate, let's try to take care of that offline and turn things over to Fari so that he can help us with how to manage an open option position, how to find an option trade that makes sense, and how to manage your position. So thank you very much, Fari, for spending some time with us today. We're very happy to have you with us.
John, it's always a great pleasure and honor to be on your platform. For a little background there, I've been with TradeStation since 1992. We're doing a neural net package for bonds, and we did our own on Spark Station hardware, built our own software, and it was too cumbersome. So we looked for a graphic presentation, and one of the guys who was working for me says, "Hey, this company down in Florida called System Writer, Omega Research, they trade pork bellies." I said, "Oh, interesting. Okay." And he says, "But they have something coming up shortly, and have some graphics. We were looking for a weight file to be attached to it. Weight file is used for neural nets." That's how my journey started with TradeStation. 3.01, I was within the first 150 users of TradeStation. The Cruz brothers were having this thing programmed in their bedroom with Sam Tennis and then Miles Dunbar, both friends of mine. And I just happened to later on run into the user group in LA, which I ended up running several years later, and for about 10 years. And I got actually more exposed to TradeStation because the management would come into town, Mike Burke, for example, or Bill Cruz and Ralph Cruz, and I would accommodate them to talk to our users, get response to it, and so forth. And then at that time, around 2000, OptionStation came out, and we've been using it since then. So I'm fairly familiar with it. I do use it in a special way. I'm not saying what I do is for everyone, but I'm more than happy to share with you. I won't get into anything proprietary. I will just go over what I do, and you see my wins and losses. You'll see what things we've done right, what things we've done wrong. I would also make the following assertion that no platform is best for everything. Don't forget that, okay? There's always something that another platform does a little bit better. And if you run any money, whether it's for your family, yourself, just more than just your own personal trading stash, but let's say you're running some organized money for a family office, for other people, other professionals, or for a fund, you really need multiple systems because you cannot, you need to have backup. So we do a bunch of that. Today we're going to just talk about TradeStation, because in case, we sometimes worry about, for example, also, some platforms are better in one areas and not in everything. So sometimes you have to blend them, and that's what we do here. But for decision support, for whether it's charts or options, our software to go is TradeStation. Always has been, probably will be. We have developed a lot of indicators there for our own use. Some of it I'm going to be able to share with you here. Some I may not be able to, but that's the purpose of this discussion. So moving forward to the next page, let's talk about type of trades. I think what you need to do is in option trading is that to say, okay, what exposure I'm willing to take, what's my thesis, when, and what kind of allocations I'm willing to apply, okay? In my world, again, this is my view of things, and I took my first option trade in summer of 1980, because I went into the market, it's in my book, right after silver crash. So 729 Dow, I was in, I bought everything, because one of my buddies who now runs Tiger said, Tiger, it's a good time to get in. And I was a couple of years out of college, and my dad had a few bucks, so it wasn't my money, it was his. We went the next day to Merrill Lynch and opened an account. Well, in 6 months, let me close my, in 6 months, my dad's account was huge up. And he thought I was the smartest kid on the block. So, what actually happened was that we started actually selling calls against it. In the next 6 weeks, it was like March and April and May of 2009. This is 1980. We ratcheted up so hard that you didn't know what you were doing. And I was so new. And there was none of these platforms before. Anyhow, so we started selling some calls. Because my broker said so. So one day I told him, I said, what am I doing this for? I got to learn this. So I was at Northrop. So I asked Northrop Library to research some stuff. There was, again, no internet and all that. What is Black-Scholes model, this and that and so forth. So we started learning, teaching myself on trading and teaching, trying to be both academically trained and also have some street smart. Not by any means being in Chicago, where like Don is, or the rest of the crew, but mainly just trying to understand from a retail point of view what we're doing there. Oops, I went back, sorry about this part. Anyhow, so over the years, and especially recently, some of these have changed, but this is what we do now. We have three types of a trade that goes on. One is earnings season, like what we're in now. And the other one is market timing. As some of you might know, I'm ranked, not right now. The last 6 weeks have been difficult. Actually, last 4 weeks I've come back. The 6 weeks behind that has been a difficult time. I was wrong on the market. I'm going to go over that. But been ranked 30 out of the last 36 trading months. I was ranked 1 or 2 with Time and Digest, which ranks something on 150 market timers. And And you gotta realize 30% of the time you're trending, 70% you're trading. So some of our trades are market timing. I will go with why I do that. Okay. And then there's also thematic macro trades. Alvaro, relax. Remember pattern? Yeah, I've got my schedule. You'll see why I'm doing it this way. All right. So let's start with the first series, earnings season. My experience has been, of course, I was a student of Berto Malkiel, the guy who did indexing at Princeton. One of the things he taught us was understand the construct. Okay. So two things you want to understand. One is how options are priced. The other one is if you're trading in option season, what are the crucial ones? And there's a reason. Find out the reason. With us, because I'm very much into SPX, there are three sectors that are crucial for me: technology, energy, and financials. Now they change obviously, but that's the three key sectors. And within them, we trade what we know. For technology, for example, the Fangums we trade, Qualcomms, NVIDIA, and so forth. You price them differently. You value risk differently. You look at the volatility differently. Energy's been a little bit more quiet now because of the pricing of the crude dropping. And of course, you got to realize at certain prices, the reserves are not going to be counted in or written off. Of course, financials, that's interest rate game. The key names there you want to watch. One of the names that I like to trade is always Goldman Sachs. Okay? Some names you start avoiding, like let's say John Hancock and so forth. 2008, we had a kind of a bifurcated market where for a while up to May of that year. We were long. We started having some losses in June, early July. We switched to shorts, and then we covered too early. Why? Because the financial was going through a lot of trouble, and we never thought they'd go to zero. So you learn. One thing you're not going to get from me here is experience. The experience is something you got to go through it. Experience is an issue. You've got to go through a lot of ups and downs in the market because you have to have a skin in the game. It's not an academic exercise. You got to be there. And market texture changes, that's something you got to be careful. One of the areas in the sectors that you want to watch is the high beta versus big cap and big caps. These are, again, big names. The way to trade them, like for example, we're going to look at Amazon today. You want to trade them with the straddle most of the time. Sometimes in the strangles. Keep in mind these costs are high. I would also modify that. I would do spreads. I'm going to go over that with you quickly. And then once in a while, I do a lot of trades. For example, I did one on Google, didn't work this quarter. I paid too much. You got to keep there are certain conditions that you have to watch. For example, the price has to be between 3-digit to 4-digit. You can't do a lot of trading with $150 stock. It's not going to work. Most of the time, you have to put them on the last 30 minutes. Because why? Because you need the other side to take the trade. It's not an academic exercise. You go in there, for example, there's an example I'm going to show you. We did back in 2013, October. Went crazy on Twitter. A lot of people in my team was in it, in my group. $300 on Google went to 11,000 in 12 minutes. Okay, we put it on at 10 to go. Google trades at exactly 2 minutes afterward, and they usually report immediately thereafter. Google trade, unlike Apple, they report real quickly, right after the equity options close. And basically, exposure we had was at 12 minutes, or waiting, if you will, and it exploded. Of course, part of the explosion came from their conference call. And we put 30 cents. Now, I'm sorry, here's the difficulty. The second item is launch in the last 30 minutes. Remember, you giving $300 in that case to somebody and you're taking that position. You need to find enough people. Remember, I'm not trading this for myself. It's a service. You need to find enough people so majority of your people can get in. At least you're guessing based on what the bid asks are sitting out there. Is that there are going to be enough suckers on the other side. Now remember, he's got to think we're a sucker. That's all it is. You give him $300, you get contracts. He is getting $300 from me, giving me contracts saying, this dumb blank, blank, blank. I just took his $300. Most of the time on lottos, that works out. Okay? Most of the time, I'm saying you're not getting any slides at all. Yeah, there should be on the slides. Yeah, I mean, I'm not using the slides. Dawn is. Yeah. So anyhow, let me move on. So the other side is they're looking at it and saying, okay, here's the dummy who just gave us $300. I'll collect a few of these. Nothing's gonna happen. And most of the time, nothing happens. Okay. You went wrong page 4. So let me come back. Okay, there we go. So most of the time, nothing would happen, except that one time, what it did. Those guys didn't trade next day. They were done. Because I'm protected by the exchange. Okay, I'll get my money from the exchange. The exchange is going to grab them, and a lot of those guys, if they did any size, they're done next day. You can't survive in business if you did it in any size. You're done. So now, some of our people did not get in on our end because there were too many people chasing so few orders that were available. One of our brokers who would clear for us got very, got into a tight spot saying, hey, Fari, I can only get these people in. I said, that's what it is. They allocate, Sometimes it happens like that, sometimes not. So, as I said, overall, hit rate is about 20 to 25 bucks, percent. Here's the logic. You spend very little money. You spend usually less than $1, okay? More like 50 cents for a 10 handle spread. That should be your goal for a lot of trades. That means you're looking for 10 to 1 to 20 to 1 return. That trade was different. That was over 30 to 1. Usually doesn't happen that often. I've done a few 5s, I've done a couple of 10s, but that 30 was very, very unusual. And Google, of course, you need a stock that it's a high 3-digit, and moves about 100 points. When those sign up, they get there. Okay. We're looking at options trade by type. Next categories of options trades I'm going to look at is market timing. We'll go over some charts there. We have a package called PMT. We'll go over that. And then we have some thematic micro trades. I have Brad Sullivan who's joined me. He runs a hedge fund in Chicago, and he buys a lot of research. And what they use is because of size he trades, he is not doing any high flyer trades in the sense like can't be a macro. I'm saying can't be a Macaru, can't be a cowboy. That's what I'm trying to do, cowboy. So he does smaller returns, but more steady returns because of the size of the bet they have on. So that's the type I'll be talking about. Let me go on to the first one. So this is some of the stuff we use. We're going to go over some charts to you. We have a couple of proprietary indicators there, CI and CI dip, Sigma channels, Sigma channel width, support resistance is standard, you guys have it. Some stuff we use for timing, and of course, we want to get a pulse of the market by seeing what the VIX dollar weighted put calls are. That's where I really started my work analytically, beyond just charting, because I want to have an edge. Most of the work we have done always has been the assumption that if too many people are using something, then the value isn't there. You really have to have your own stuff. So that's what I'm going through quickly. Let me go to the next one. Sigma channels is a standard deviation, pretty much a superset of Bollinger Bands. And here's your travel. This is the potential for the move. You can see what the ranges are. And we usually consider between 2 to 3 sigma plus or minus, this area right there. Just typical charts, you can just modify it. Ours is a little bit more sophisticated in some areas, but mainly you can just take Bollinger Bands and modify it. Okay. Okay, so let's stop here. Let's not go here. Let me share some charts there, and then we go to let's see. Let let me go to my, okay, wrong chart. Let me bring this chart up. Okay, here we go. Let's look at, okay, let's look at Netflix. Okay, that's an example of trading there, and I'm going to also bring you my trade. You'd see how I put it together. This is an EPS trade, first section, EPS trade. Okay. Caterpillar, we didn't get it. Sorry, just that happens. But here's Netflix. Okay. So here's my email for Netflix that went out. Okay. And what we did, we bought 165, 170s. Okay. Look at the date. This is how we go through. There's a date, and we give you our logic, what we're looking for, what the construct is. These are orders for 25,000. Okay. So we went out there. Here's the timestamp. It goes out with email and goes on Twitter. Okay. Now, the following, the exit we had was on the following day. Yeah, this is the entry. Here's your exit. Obviously, you've traded before. Here's the following day, and we hit 660. So 300%. We're going for about 210, and the exit was 660. Now, we do tell you it's risky. I'm going to go to the chart, show you why. And here's, and you got to be available in the morning. With the EPS trades, you have a small window. Okay, so keep that in mind. Now, let's go over how I chose that and why. Okay, the date there is 7/12. Okay, so let's go to our weekly charts. I usually do a top-down view of things. The monthly, weekly, these two should be reversed. Daily and the hourly. Hourly is for in and outs, really. It's not for decision making. I make most of my decision between weekly and daily in terms of pricing. The trick is I'm going to show you what we do on how we target these. What is, how do I come up with these levels? This is crucial. This and that, okay? And what does MIVs and beta mean, okay? You got to look at it because it's all Greeks. You got to understand what you get involved in. So, obviously, we're buying a day before, or a couple of days before. That was on 7/17. We went in at 3:40 p.m. So that's 7/17. At that point, you'll see what our targets were. You go back up here, you'll see the Sigma channel was 162 to 167. Okay, 2 Sigma and 3 Sigma, 162. Guess what? I went in. I went slightly above that. Okay, and took up to 170. You see that? 165, 170. So one of the strategies you want to buy is slightly out of the money, okay, on a call spread. Now, here's your problem, typically. And you're going to ask me, how do you answer that? Well, you have to follow these things. Okay. Here's the monthly. This baby is a monster. Okay. Straying all-time high. How do you, look where it is now, 183 is at, hit as 191. How do you have the guts to trade that? You know, you get this over time. That's the whole thing I'm talking about. Let me put this up on a, I'm sorry, not there. Well, let me put it like this. This is the daily. Let me put all-time high on this. You get to know what the company is doing. You keep following it. You there we go. Okay, so it's trade 191.50. All right. That's and we were trading at 161.60 as we went out right there. Our goal was only 167. Now I usually try to find this goal somewhere inside of the spread, near the upper range of the spread. You know, either it's the, or it's a put or the lower end. You can do some put spreads also. Why do I want to do spreads? I explain that to you. Let me bring, let's go to Netflix here. One second. I'm jumping up and down That's what this business is. You have to do a lot of detail quickly. There we go. Oh, I'm opening too many here. 1 second. There we go. So what I do is that I have a screen that I've modified of the OptionStation Pro, and I want to see some of the details I want there. Now I do a little modeling before that. Okay, I come in and say, listen, obviously this is what our trade was. It's going through August 4th, and this trade was 6:15 now. But obviously I'll set it up, what I want to buy. I'm looking at the money. Of course, this was down up here, 160, 1 and 7. We was right about there back then. Okay, different prices. But I do a modeling. I want to buy at the ask, sell at the one leg long, one leg short. Why do I do that? Well, take a look at the volatilities. Take a look at, for example, now we're at the money. Your volatility is 29. Okay, and what you want to do is you want to crush the vol. This is crucial. Why? Because I grew up, a good portion of this was in Chicago. I went to Chicago in 2008. Really, both the top and the bottom of the market all at once. Within 1 year, it went from the very, very high to very, very low. And half the city was unemployed in the financial sector. You learn to survive. And one of the things is that a couple of the key traders on the floor took me under their wings and helped me more. Not what I do academic, but also put it to work. And one of them is you want to crush the vol and the theta. Two things that are going to go against you constantly, because it's a moving shell game. You got to understand the actual model. The two key inputs are volatility and X minus S. The difference between you're in the money or out of the money, and what vol you're getting. As you move up and down, take a look here. For example, we've just done here, but you can see the volatility change. Okay, let's go to something. It's tomorrow, for example, XOM. That's for tomorrow. Now, XOM is a oil, but look, it's still, even they haven't moved. Look at the front one is 40. I'm sorry, front week is 40. So what you want to do, you want to be able to crush some of that, and don't be a cowboy. One thing I want to teach you here or share with you here: don't be a cowboy and try to be long one trade. I'm saying one leg. Try to be long and short. First of all, you pay out less. Secondly, your net is lower. When I put the Netflix up, here's something I look at. I'm going to talk to you also about this is the 04. I go to analyze. Here's what I'm looking at. What's my combined delta is. Yeah. And what's my gamma is, what's my theta. It's crucial for me to know combined, because that's how you put them together. If you take this out, let me come back. Let's let's do for now, for example, when I go let's say we want to go long from here. Okay, just theoretically, you're buying 185s. Okay, you go back and you're selling, let's say 195, just to say. Not I would do a 10-point. Not on Netflix. Not up here. That's why also there I did only 5. But just for example, you'd see the two details. You put them on top of each other. Okay, so you get your combined spread. Okay, and I have a habit of going to one contract to see what my numbers look like. I have a 31 delta, and gamma is 244. Now I go back in and play with these. Why? I'm looking at different combinations. I'm looking at where am I on the chart. Again, come over here. You got your sigma chart. Look at what the sigma charts look like. You have to look at what those targets look like. Remember, this is before the number, not after. Right now, these blew up because like a huge vol expansion there. But I would come in and go to the chart, come back in side by side, 2 monitors. Look at number of what ifs. Do not rush to get out and put the order out. Okay. Sometimes in my chat, people were asking me, "Is it ready yet?" No, it's not. Hold on. We're looking again for high probability trades. So you got to take your time and see what is it that makes sense. Now, one of the key items, again, that could help you is understand the sigma channels. Okay. For example, let's put up tonight's trade, which we did not get in. Actually, I missed the bullet there. Okay, now this is obviously doesn't show it yet because it is in process in the after hours. Okay, but this is Amazon. One of my guys in the room, Brad Sullivan, he says, "Listen, the rumor has it that they're liquidating Amazon ahead of the earnings." Somebody knew somebody, so I stopped going because I was going to go bullish up here. But when you hear something like that, you get that down. Obviously, you got to see that tomorrow. This is not a good example here. This just happened. Why? It doesn't show on the daily. But my point is, as you get close to the earnings, these balls change, and you got to look at the volatility. The signal channels dictate to you most possible location they're going to go. So what you do, you go to your option chain and look at those signal levels. Yeah, for example, let me go to Amazon. Okay. And if you guys want to look at something that's coming up next week, throw it out there. I'll analyze it for you. But here. Okay, well, it's not simple. Option day is not simple when you're doing high beta, high cap names. But here, so you would come in and you look at what signal levels you're in, okay? What's your bias, obviously, and what you pay. One of the problems we had, also, what you pay for the spread. One of the rules for paying the spread. For example, we're trading at 10.15. Okay, of course, this is what the price is. We're down 38 handles in the after hours. But let's say it's before the number right now. It's 10.15. And let's say you want to be bearish. You take a 10.15 put, you buy that, okay, and you want to sell 10.05. That's 10. 10 handles there. You got to go in there. Here's what you're going to be buying. Okay, and you go back, and here's what you're going to be selling. This is 10.5, okay? Put it on top of each other, okay? Oops. And what you need to look at is what's your combined values. You're paying 225, all right? 225 is not bad for a 10-handle put, okay? Why? Do that math. The rule is 0.30. Write it down. You don't want to pay more than 30%. Of the spread length. If it was a 10, it was a 5-handle, you don't want to pay more than, this would be 30 cents or $3 for $10. If it was a 5-handle, you don't want to pay more than $1.50. Why? The expected value of, if you repeat this many, many times, if you're paying over 30 cents, you're going to lose. It's not going to work out positive. So one of my rules is to keep it at 30 cents. Today, here's the reason I'm showing this example. This is an extreme example. Before the number came up, when this was trading around 10.50, 10.55, not where it is now, we would pay, the premiums we're asking was $6 for every 10 handle. That's a 60% of the spread. That's suicide. It doesn't mean you cannot win the next trade, okay, the N+1. But it does mean if you repeat it enough, the E of X, the expected value of that strategy is 0. Okay, so watch signal channels, watch your spreads, make sure you're crushing the delta, okay, and the theta, because by being short one of them, otherwise you're taking it outright. So being an outright, you're a cowboy. Cowboys always lose. You can trade 1 or 2. I used to be a cowboy myself. I put $1,800 on Google one time, and it went to 5,000. I was so happy as a clown. Guess what? You can't do that always. Somebody woke me up and said, Fari, you were nothing short on the other side. And I would say, wait a second, if I'm short on the other side, I'm giving something away. That means I'm long from this level, short from the next level. Why would you do that for same expiry? Well, because you want to take some of that volatility out. Right before the earnings, volatility is high. Let's go back here. Let me come back here again. If you look at this volatility that you see here, there's your vol. Look at 131 versus 51 versus 48. As a matter of fact, one of the strategies would be to take something like that and build a back spread into it. We'll get into that too if you guys are interested. But by selling the upfront, and then being long multiple of the one down the road, next week or following week. So long story short, you want to crush the vol and theta. Also, as the time goes on, let's say you're not buying tomorrow, If you're buying tomorrow and out of money, okay, I'll buy it. You can go and get outright. That means by outright, I mean you go to, let's say it was trading at, let's open all of them. Let's say it was trading at 10.55, as it was right before the close. On 10.50, let's say 10.50, just to make it simple. Okay. Then let's say you only want to buy 10.60, which is not ever come on. That's a lot of money, $14 per contract, per share actually. So a 100 lot share, one option contract was going to cost you about $1,500, $1,480, right? Way too much money for my blood, okay? But you buying all of this, you're buying 158 vol. That's what you're doing with 1 day to go. So I would suggest you go out and a little bit less, but you have less to lose, but you have a less chance of getting there too. But it's a 1 day. But if you're going anything out, you have a chance to hedge it. Hedge it by selling something higher by crushing that out, so that you net out. I usually like to do 2 to 3 weeks forward, maybe 1 week forward. I want to crush my wall. I don't do any ratios. I do it, keep it simple. For my own account, I may do something a little bit more exotic. But when we're sending a trade out to a bunch of people to trade, you want to keep it simple. You saw our samples. You know, it's two-legged. Sometimes you'll see, here's our platform templates. Sometimes you get leg 3, but usually don't. We don't go off leg 3s, after the leg 3s. Plus, we have to give us a chance to repair. Okay? But anyhow, so you want to keep the high beta, big cap names fairly tight. No more than 30 cents on the spread. Make sure you're crushing it. Make sure you're not doing ratio. 1 to 2 weeks forward. And your targets, just not what you think or your shoe shine boy at the club told you. No, go to signal channels. Go to where you see the vibration, where natural vibration are happening. How do you get that? Is the most recent activity of the stock. It's a 20-day moving average. That's what this is. Let me turn off a couple items. And it's a 20-day moving average, which is the center, and the standard deviations of the returns. So if you of the price, I'm saying price action during that time. That's a moving target. So these numbers constantly change, but at least you know the probabilities. You know 67% of the time you're going to be in one sigma event. That means +1 to -1. 67% of the time. That's in the handout. 95% of the time you're going to be at 2 sigma, up to -2 sigma. That's your range. Those are very useful for strangles and straddles. I'm assuming you guys know the strategies. I don't want to do what. That's the reason, for example, I teach at SIBO is they told me you're not talking like another option trader. I said no, I'm not interested to teach you what a put is, what a call is, what a strangle, or how the mechanics are. I assume you know that. What I'm interested to show you is how you the nuances there using better tools and increase your probability of the hits. And then the 3 sigma is 99.7%. So, and then you got to understand some of the indices. For example, I know from experience, if I'm trading SPX, I got to watch it. SPX doesn't hit 3 sigmas. Let me go out there. Let me turn these off. You'll see. Here's the 2 lines there, by the way. Let me turn this off, okay? If you look back in history, the chart will tell you. Any decent indicators will show you that you got to understand the patterns. You know, individual stocks, they have higher vol, so they move more. So a little look in the history is good to understand where the what extremes are, what the outliers are. How many times we went there? How often we did that? Is it this year? Is it last year? Why? Because textures are changing. What the stock did last year is going to do with this year. So look at more recent stuff that is more valuable and see what patterns that follow. Indices being an average, you have a tendency to be between 2 to 3 sigma. I'm sorry, -2 and +2 sigma. When you go beyond that, when you go to high beta stocks, let's say even Microsoft, then you're dealing with -3 and +3. When you go to something crazy like Amazon, Netflix, you're gonna see -4. I doubt you see +4. A few times you might. FB today act like that. Let's go to FB, for example. Here's another trade. This is a trade we put on yesterday. Let me go to my That's a good example there too. Now we're half out. We're not fully out. We're half out. Here's our trade. And we talked about the chart pattern. Okay. This is the time it went out. This is Central Time. You see time stamp Central Time. We like the both weekly and daily. And the walls were cheap. The walls were 34. 34 for FB is cheap. Again, how do I know that? Experience. Looking at it. You know, always have somebody to mentor you. You know, you just can't jump in and be a cowboy. And we're waiting for 173, not to pay more than 190 for a $25,000 risk capital account. We said do not spend over the 760. Why? We don't want to be over into a position more than 1,000. Occasionally we may do that. We may have a really good day on futures and throw some of it at the options. That's called house money. That's different. But usually we want to stay in 700 for a $25,000 account. So about maybe $1,000 per bet equal dollar value. Obviously, we want to keep an eye on what our beta is and MIVs are because we want to make sure we're not mixing Johnson & Johnson, for example, with Netflix. Two different animals. Anyhow, then this morning we exited out half. We sold to why? Because we have time to go. Those are August 11th, and market was, I got a 4 something out myself. The 455 area I got, or 51, 451, 452 I got out. Now, where is it now? Let's see. Again, go back to your system here. There's your FB. It's loading. Go to analysis, and it's 295. Now, what happened there? Now remember, the 7.5 handles there. Why did it go down? Well, a couple of things. Let's analyze that. You know, sometimes I do post-mortem at nighttime. I go through this, try to find out. Obviously, that one day, you can see the shock up. I'm sorry, that's SPX. Let me come back here. Nope, wrong chart. Hold on. Let me bring back. Long day for me. I'm sorry. This is earnings season. And today's the busiest day of all earnings seasons. But 3rd week is always busy. But here we go. Here is the daily multi-time frame. Here's what happens. When they start selling Amazon, everything's sold. You could see where we were on a weekly, on hourly. That was hourly, and the gap up. If you look at the daily, you'd see we almost hit 3 sigma, but not hit 3 sigma in a while. Actually, none for this year. Yeah, none this year. We hit 3 sigma. For you measure it against itself. That's key. As your price moves up, I know these are bigger moves, but you gotta measure the strength. Why? Logarithmic return. Understand the actual model. You have to understand that. If you sound geeky, this may not be for you. You have to understand the underlying reason. It's all Greeks, right? The gamma, the beta, the delta, the rho. You got to understand what the interactions are. X minus S, MIV. So as you move forward, you got to see how it move against itself. The benchmark is the asset itself. Okay. So we moved up almost 3 sigma. Okay. And of course, intraday, everything changed somewhere in there. We got out a little bit here. I got busy. I did not do anything there. And now we're down. Why? 2 things have happened. Volatility has come down. Why? It always it does. Prior to the earnings, let's take a look at Tesla. Tesla is coming up, right? And it's a little bit far out, but let's put Tesla in there. Look at the analysis. No, I'm saying the options. And let's shrink this. Okay. You could see, I don't know what Tesla reports. Somebody may want to look at it. But you see, most likely, I'm thinking somewhere in August is going to report. Why? There's your peak right there. And as you move away from it, it drops. Well, because the data is unknown, the EPS, obviously, we're going to have a big heightened level of volatility in the pricing right before it. Then you got to whisper a number. How do you get the whisper number? Go to whisper.com. Take a look at what they're doing. We always go to whisper. see what's out there. Is it always good? No, it's not. But go to whisper.com and earningwhispers.com, sorry. And let's put Tesla in there. Okay. And you gotta feel what they're asking. What is it? It's August 2nd, see? I said what, August 4th? By just looking at here, see? 866. So what happens is that you get a curve that goes up and comes down. So if you want to run into their earnings, you can't do that. Some people do that. You buy ahead of it. You buy the rumor, sell the news. But you know one thing. Post number will get sucked out. Why? There's no longer the unknown. The unknown has become known, so that the pricing, it gets eased off. So even though you may go in, here's one of the things you need to realize. You may hit the target really well. This is something that took me a while to figure out early on. Of course, we don't have the tools we have today. You get into the pricing and you make a projection. The market goes your way. The stock does what you expect, but not enough. By enough, I mean that this is a logarithmic. Remember, time and price in the Black-Scholes have to go your way. If it just moves slightly, it could be offset by the loss in volatility. So X minus S improves. Let's say we had only gone 5 points up total, not how we close that, but I'm talking about early on. Remember, this heightened the volatility a little bit. So let's say we go down 2 points, 3 points, like 1%, 2%, it dies. We were up. We traded what, intraday? We traded at 179. Yeah. So that drives the volatility up, and once it's out, it gets sucked out immediately. Here's what happened to it. All the volatility got sucked out, and now, even if you could be right, the value is not great. So what we do is we sell some out. Now, you gotta understand the pattern too. A lot of times, if you go back, take a look at the chart before, you'll see when the earnings come on a stock like FB, or for example, Google does that a lot. Okay, Apple does that too. You get initial burst. There's a pullback. Okay, the earnings are good. The guidance is good. Remember, ultimately, it's the guidance that drives the price, not the whisper number. So the earnings are good. The guidance is good, and we go forward. Then day or two, it gets sucked out, and then the stock gets another wind, like 3 days, 4 days, 5 days later, the next peak move. Sometimes you want to you go to the vaults. You got to start looking. That's why you come here and you go through different expirations. You open them up. You measure them. Okay, let's make it really small. Make it simple. Let's say 6. That's it. So you open these. Okay, you got to take a look. You got to look at what balls are at. Okay, and what there's your implied ball there. Let me expand this. Okay, I usually put this in the order I want. So I did it call it. Here's your implied ball. You want to look for some liquidity versus what the balls is saying, and the time is to the earnings report, and also what signal levels are. It's not easy to follow, I understand that, but it's a multi-dimensional chess game. You have to look at several what ifs. I don't try to make a trade too quick. Sometimes it takes me 45 minutes to put a trade together, maybe half an hour. And I have an assistant, which we collaborate on Google Sheets. That she does it from her home. Go to her, she sees what I'm doing. We're sharing that. We have a huge option calendar there. We know what names are coming out. It's on our watch list. We also watch what we have been trading before. Okay, we go back and say, all right, what are the names you've traded? How are the results for? And we use that in further refining how we do next quarter. Okay, it's a very involved situation. Otherwise, you're going to be doing it like a cowboy. It's a hit and miss. That's not what we want to do. And we still get into trouble, by the way. Why? It's a leverage game. You understand that? Remember, you don't need to hit all targets all the time. You do 30% of them, 45% of them. It's a big return because remember, these are defined risks. What is the defined risk? We have a known money we're always we do call spreads or put spreads, and even downside. I'm going to show you one on Qs for market timing. We put spread on. We buy a put. Let me give you an example here on the screen here. Hold on, so you guys can see. We buy a. Where's my? Sorry, guys. There we go. Here. We buy a put. Let's open this thing. There's a 10. Okay. We buy a put here. Okay. Let's say 335. Trading at 340. Yeah, that's at the money. We buy it 335 in the money, and we sell 325 lower. Okay. So again, to get rid of some of the vol, to get rid of some of the theta, so it doesn't deteriorate as fast, and some of the vol is sucked out by design. But we know what our risk is. We're not short a call spread. We're not short a put spread. Okay? We're long a call spread. We're long a put spread. So we have a defined risk. We know what we're risking. We're not candles more than that. So as long as you define that, make it small, use same bet size. That's the trick is, as much as possible. Same bet size. If you feel good about a bet, maybe you can increase it a little bit. But I suggest you stay with the same bet size, and you play now no more than 30% for the spread. You're gonna have some good winners. You will. It's just that you just can't be a cowboy. You're not sure if something passed. Today, Amazon, I passed. It just didn't look right to me. So, now, let's see. What else I want to talk about earnings season? I think I've gone over that. Let's go to market timing. Okay. Market timing. Let's me first of all. Let's see. Let me get a chart for you first. What is market timing is and why? Quickly, you want to know what should be your bias in the marketplace. Okay. Let me get the little chart up for you. I'm just going to give it actually from the website. And there we go. Let's see. Here's the market timing. Okay. Now, this is up to date. We had a hit here last quarter, but here's what market timing is we have done. And this is verified by Time and Digest. We changed some indicators in, I don't know, Thanksgiving, December 2014. We announced that in January of that year, 2015, saying that we're going to go after every single market timer that Time and Digest has, which is about 150. And we're going to take no prisoners. Okay. In 6 months, some of them start calling me, like, who the hell are you? Where'd you come from? Remember Butch Cassidy and Sundance Kid? Yeah. Who are those guys? Exactly. And this is verified by them, and we make every position change. We send them an email. And so we use this bias. Now, why you want to be doing that? Of course, here's our ranking, by the way. 3 years, 5, 8, and 10. This is the most recent one. Again, now, I'm saying this is not the most recent. This is the last time I was this high. Right now, I'm not even in the top 10 because because of this mess right here. Just say I made a mistake. I was on a trip. I had a couple of medical issues, so I was not paying attention. That was my fault. No excuse. We're going to come back. Not a problem. Now, why do you want to do that? It's because, especially if you're an older person, you have a 401k. Let's go to the market timing here. Let's say you have a chance to go in and out. What you want to do is you want to be out of the market when things get rough. You want to be in the market when you should be long. And maybe summertime, you want to be flat. To do that, market timing was created. It's a practice. A lot of people actually, we get a lot of clients from the Time and Digest newsletter. A lot of people follow it because they show ranking the third party. There's father and son. They don't give a damn about me or you or anybody else. They do their work. You send them their emails every night. It's all time stamped. They have rules. And they rank you. Issue is not what you've done this one trade. Issue is over time what you've done. Last 3 years, I've nailed it. If you go there, you'll see 30 of the last 36 months, I was 1 or 2. And now what do? Is we have certain rules. We have some charts. We have a package called PMT. We go through these charts, okay, and we come up with a bias. The purpose of this discussion is not how we do that. That's not our purpose. Our purpose is how to take that information and trade it, okay? And so what we do, part of our service is I do this every weekend. The package comes out, let me log in, and comes up with a solution. Now, what I do is I take some of that, apply it into our option room for our option people. For example, here's the package book. And then, by the way, you have a full history. You can go back to day one. Well, day one in this format, the way we produce it this way. We've been doing it for 4 years. So, but about 200, half of them are in this format. Because before it was just an email service. And people said, hey, I paid for this. Why don't we put this together and do it formally? But what we do, you can see there's a transcript, there's a charts and all that. But here's the most recent one. Let's talk about the most recent one. And this is what we do. We give you a bias, okay? We show you what our bias are. And they, by the way, they're subscribing to this to themselves. They don't pay for it. But they see what you see. And we give them targets. You give out clients targets. They go out and you see timestamps in real time. And for example, over this last Sunday, we had no bias because we had just covered. We had covered our, we had gone flat on July 19th at the all-time high back then. And so we had no bias. We said we're going to wait a day or two. And then we got long again, and here we are. We give an upper limit, primary, and secondary target. For primary, you take 80% out, and you move your stop up. It's all about money management. That's crucial. You guys have your options too. Now, we give a specific trade. We give an expiry, and you see it strikes. We also, but you trigger off of the SPX. Why that? Because SPX is 80% of US equities. It's a Nimitz class carrier. It's a big boat. It doesn't go back and forth, go crazy. Not the future. It's the cash. Okay? It's the cash. So, and then we give you a target. If it hits this target, you close your position. Each week it's updated. So I take those and put them in the trades. Now, let's give you an example on that. Let's go to the next slide there. See my channels are going there. Okay. 697 Qs. All right, let me go there. So this is Qs. Okay, there we go. 697. There you go. This, oops, hold on. Let's try. Oh, there we go. I think this was when it was sent out. Hold on. 697. Hold on. Hold on a second. Where's 697, Jack? Oh, there we go. There you go. Here we go. Here we go. So there you go. So 697 went out. This was 27th of May of last year. Okay. And this was call spread. Again, we hedging it. We're long and short. This is wrong. Yeah, this is this is reverse. Sorry, it's yeah. Sorry, they probably have that one that fixed that. Yeah, yeah, 697. So sorry, let me do this way. There we go. Yeah, this should be cost, but I'm sorry. This is the error there. You bind the little one beside the bigger one. Okay, that's right. And then there we go. All right, there we go. There's an email. We found a mistake. Boom. We corrected. Immediately sent after 12 minutes later saying, hey guys, that's wrong. This is the correct. So that's what you buy. And then here comes there was a recap on that. There was an update we sent out. And then here's your exit. And 52%. Now, what did we use then was market timing. Now, sometimes I prefer to do Qs because Qs move faster as long as there's a high correlation. Remember, we do our timing on SPX. As long as the high correlation is, and because of also Pyramid Digest only ranks us on SPX, we use theirs. As long as the correlation is decent, usually is between Qs and SPYs. We trigger off a SPY, we trade the Q, we give you targets there now. Again, I go through, same routine I went through. The selection is the same. Sigma channel, let me come here, for example, let's see, let me go to here's what's called market bias. Let me put this up here. Market bias, here we go. This is what goes on Mondays. So I'll put a Q there, okay? And I'll put the NDX here. So I'm signaling it like that, okay? So I know, and these are weekly levels, guys. Hourly charts, okay? Hourly bars on weekly levels. We're one of the few people who plot that, can make that mix, by the way. That these are based on weekly activity. Why? Weekly levels are very crucial. Look how it hit it. It hit it, boom. Look also here, this is the Qs, of course. There's a 40-to-1 ratio there, that's why I do stuff like that. But my point is, I will send the order out for your Qs to you guys, but I'm timing it off of what I see here on the NDX, as long as correlation is high with SPX. Because I'm not doing a market timer on NDX. I just use it for that particular trade. Sometimes we also do SPYs, okay? Now that goes both puts and calls. On a put spread, let's look at 836, okay? Again, I'm going a little bit too fast. Realize that it's just my nature, you know. My dad was a fighter jock, so early on he gave me a lesson. As a young man, in this house, we have, it was for the first fighter week. We did really wrong, you know, it was a good Persian in America. With a shop, he said, listen, we have one speed around here. It's called full afterburners. You kind of wake up, but it's up to you, quickly. So, here's what we looked at. Put spread. Here's the Qs. There's a little discussion there. Actually, there's wrong. The market PFT webinars, we invite everybody that come in. Sometimes we do that. And we didn't get a trade out then. We sent it out to members later. But we discussed it and something like that we'll be looking at. And here's what we went to. So take a look at it. You'd see what you see a time and date, and you see our call. And here's the put spread. And yeah, 100% 1 week. So so here's the EPS section. EPS, earning per share, is the first month of the quarter. That's always there. Yeah, earning calendar, fairly heavy. Let me quickly log in there for showing you what we do. It's called Option Journal. So I have a staff that goes through that. Very organized. It's got its own chat room, its own Twitter, because we have to get to you. We can't miss it. But it goes back. Here's our history. We go back. We look at all the trades we have done. Whisper numbers. There's a lot of upkeep we have to go through. And, for example, we know what's coming up. And we write it down. Everything is noted. As much as possible, you know. Why? It's valuable. When you come back later on, you understand what you did. What were the numbers? How did they miss? You keep an update going on. And what's coming up. You know ahead of time what to apportion your time and energy. I look at some of these over the weekend. And then, so I know the week what I'm looking to. And then, that's the first month of the quarter. So, like the first week of the first month, after, to about first week of the second month. After that, we switch to market timing. Occasionally, we mix them, but usually the last 2 months of the quarter are market timing. What do we use that as a PMT package? We will see what our PMT package is saying because we already have enough trades during this first month. Just not to be slow. We don't want to go feast to famine. So to level some of that, we use our PMT package. We make calls there. Then there is also the last category. Oh, somebody's trying to flash me. Let's see what's going on. Okay. Then, hold on. Am I? Are you still here? Okay, gotcha. Sorry. Wrong screen. Yeah. The last but not least is the thematic, which is, I'll give you a couple of examples. That's the stuff that Brad Sullivan does. So let me come here and say, Visa was one of them, for example. Okay. Let's go to Visa. Okay. There you go. Trade 850. Okay. Here's what we did. Here's a trade 850 that went out, and you see how he's doing it. It is looking at simple trade, not too fancy. Keep it simple. KISS principle, exactly. But look at what the percentages were in the earnings, what the balls are, how much you're paying for, so on and so forth. Okay, and it's not a huge, it's very stable names, but you put some dollars into it. And then here comes the exit, 50% ROI, in about, let's see, on the 26th, we went on 20th. In 6 days, we do about 52% you come out. Okay? The email goes out to you, tells you what to do, and you go out. So there's another one, 835. Now I don't think 835 worked, but I want to show you how that was done. You can see. There we go. Hold on, 835. There we go. You see, it's very thematic. You see that. Ahead of FOMC, an event is coming. Event driven. An event is coming. You look at a lot of different values, possibilities, and then you take something, an asset like HYG, which is the junk bond, was a corporate bond. I don't know. It's one of the two. I don't trade it. He does. You take one of those, and he had just joined us at in this capacity. So I sent it out. It's his trade, and what it does is that it allows you to, again, get into a trade before an event, not to pay a whole lot. You can load up those relatively cheap. Again, you want to keep your bet size equal and a small portion, 1 to 2%, 3% tops of your portfolio, no more than that, okay? But equal amount. Don't go trade 3,000 one day and 700 next day. You may work one time. I had done that. But I was lucky. Now that I've got more experience, I chalk that to being lucky, not very smart, okay? I remember one time, 16% portfolio was in Google. That's not smart. Now, it hit. And they thought, hey, I'm racing size spread. Was I happy about it? After a while, no. At the beginning, yes. Oh, I'm a big guy. Yeah, I can do this. But as it settles in, you see, you cannot repeat that easily. Why? That's why it was too big. I was too nervous. I didn't sleep for a week. Don't do that. You got to be alert. In my book, Master Traders, published by Wiley, there's a guy named Gil Caffrey. He's head of Tiger Management, one of the largest and oldest hedge funds out there. He writes about this. He says, excellence is repeatability. If you're any good, you have to repeat it. Hitting a target doesn't mean you're good. It could be luck. You don't know. Only over time you're going to find out. And appreciate how good you're working, how systematic you are, how disciplined you are. Let's see. Do we have anything else? I think I'm done here, Don. I'll be more than happy to take some questions, or as many as they have. I'm sorry it's been a little bit too long. Can we give a template copy of my trade worksheet? Sure. I'll send it to Don, you can send it to you, yeah. I'll have to copy paste it to you and then you have it. I can't send you all of our worksheets, it's all related. But the one we have here, yeah. If you have, yeah. But here what we do, here you can see, there's the templates down there. So here's and we have blank ones ready. There's a blank one, let me go here. There's a blank one ready, yeah. Yeah, it's ready to go. Why? Because the team. I start working on something, they add to it, they come back,
So
how's my class? Yes, sir.
Yeah, so what I think, Fari, the best thing is you can forward that to me, and anybody that needs one or would like one that's here in the webinar, please just drop me an email. I'll put my email address here.
Absolutely, yes. Sorry I'm long-winded. It's the third week. There's a lot going on, and I'm very hands-on. I have a team of about 5 people in the option room, but we go through quite a bit, and thank you, Luke. I appreciate that, sir. We are engaged, and because today was the Thursday. I didn't know when we set the date up, by the way, and neither did I think Chris or Don. But this is a pretty long day. But hopefully, give you some ideas. I want to caution you to be not so aggressive. Okay? There's an old saying in the option business that says people who talk options divide by 3 and believe half. Okay? What does that mean? It means that a lot of times it's not going to work out. A lot of option trades are tough. You really have to be disciplined. You've got to watch your back. You got to be defensive. As long as you're defensive, the good trades will fall into place. The way you get trouble, which I used to do, I wasn't careful, it was that I would go on a streak. I remember one time I went, I don't know, 17 or 18 trades with no loss. No loss. It's mission impossible. I mean, I remember the guys in Chicago were telling me, I don't know what you're smoking or what you're having for breakfast. Tell us.
One guy from New York said, could you come in and teach my traders? What are you doing? Market was helping me. Market was the right place at the right time. And I wasn't doing anything else. Full focus on that. I wasn't in the chat room. Just email getting to people, okay? Thank you, Dan. But 17 or 18 trades in a row, it's monster. Yes, 50%. Caesar's asking me to use a stop loss, 50%. Yeah. Sometimes you cannot hold that, by the way. Gap down, gap up. You have to understand that. Yeah. But I want to be, I want to do, remember, I want to be 30 cents on a spread, no more. Plus, I'm willing to risk half of it if I can get to it. If I cannot get to it and past 50 cents, I'll take my loss that day and close and go. Yeah, we close a lot of stuff. We don't let it go to expiration. We also have a streamer, live streamer in the option room that is showing mark to market where we are, because when I come in the morning and another person maintains it, I don't do it. It's called checks and balance. So when I come in the morning, I want to know what my positions are. Or Brad wants to know our positions are. But they're helping, they're understanding, make sure that our values are correct. And it's live. We put actually we use eSignal. eSignal data goes in there and gives us pricing. It's just another chart, just an Excel sheet. That shows us where we're going. And as we execute that night, they mark it to the market, take it out, balance it out, and so forth. Yeah, I've got a team that handles that. There's a lot of work here. Earnings season, we go through 150 names, okay? And maybe trade 10 of them. No, maybe more. Maybe trade with 15 of them. Out of maybe 10 trades, we take one. Yeah. Okay, yeah. And then we do some market timing on the second month and third month. It's become a machine. We've been doing this since, in this format, 2011. Yeah, so it's like 6 years now. So it's like 24 quarters. You get that cycle. And then Brad does macro stuff. Stuff that's just like, sometimes he may buy here and sell in Europe or vice versa. Or he does ETFs, like value versus growth, which is way above my pay grade, okay? But he comes in, but he's very, very systematic, very thematic, actually. He writes down his logic in detail, very specific prices. He's actually much tighter on price than I am. See, I may chase something. For example, I refuse to chase Boeing, okay? Look what the Boeing had had. What a day Boeing had yesterday. I'm still kicking myself in the rear end, but here's Boeing. Notice I go same charts. I never change indicators, nothing, because I want my body to give me that feel. Look at the Boeing. Boeing had his best day yesterday in I don't know how many times. How many moves, if you will, but it was a 10% move. For a $200 stock to move 10% already at all-time high is a very rare thing. And it's a part of a Dow. Guess what? In here, Susie was begging me to take her note, and it's really, can you ready to go in? I was getting my butt kicked in a couple of futures trades. And I said, not now. Next morning, I went berserk. Because this was a BMO, was part of our list. We had looked at it, we had the trade ready. We didn't go in. So, now, we changed the price one time, only. Okay, Brad doesn't do that. Brad's he doesn't go after stuff like this. It's because he's trading much bigger size. So it's more very, he's looking for 20%, 30% return is happy. I'm like DH, if you know baseball. I'm coming in, bottom of the seventh, bases loaded. I'm swinging for the fences. I want to do grand slam. Not always can get there, but when I do, it's pretty good. Get great feeling. I mean, now, how did I get there? 20 years I've been doing this. Not full time, okay, but off and on, and looking at it and blending different technologies. Talking to people, looking at charts, looking at quantitative data, looking at option data. I spend hours on the weekend on the option stuff, on option chains. You got to know your Greeks, okay? I have a number of books on options. I've reviewed them for Wiley, for Bloomberg, so forth. Because I teach at SIBO myself. That stuff I do is a little bit more not easy to follow. I understand that. I'm a high bandwidth talker. I can write it for you, the answer. I'm not good at explaining to you how well I got there, but I got the right answer. Okay, that was in high school. Even in college, they used to tell me, don't go to the blackboard. I couldn't explain very well, but I had the right answer. Intuitively, I know what I'm supposed to do. Now, is it always true? No. This is a random event, and come to appreciate that. So what you to do that, you have the different behavior patterns you have to learn. How to be defensive, how to not to go crazy. For example, this could have easily gone the other way. You know, you don't know. There's a known unknowns here. Okay? What do you call it? Rumsfeld. Read his book. Known unknowns. There's someone out there. It's this is, my background was financial engineering at Princeton. The decisions under uncertainty. It's not a perfect world. Engineers are better at options, but they're lousy with charts and trading. So they get very, very disappointed with themselves. Lose that. Be very neutral, Don't get too excited. Don't get too down. You got to think of it as a business. Watch the odds. Keep your discipline. One thing I want to tell you, keep your discipline. Don, I think I'm done with my sermon. Sorry I went too far.
Don't be sorry. Everyone enjoyed it. Anyone who stuck around to the end here had a great time.
Let me tell you, if you were involved, we used to have market time webinars go 3 hours. Well, we started with 700 people,
Right.
So yeah. By the time I was done answering questions, it would be 3 hours, 2.5 hours. So.
Fari, thank you
But please give me a copy of it. I've got some people who would like to look at it. They couldn't make it today, but I'd like to send it to them.
Outstanding. All right. Thanks so much to everyone who attended today, and those of you that are here now. Please, as we mentioned, that worksheet will be available. I'll get it from Fari, and I'll forward it to you. Let's have a great trading day tomorrow. Let's try to use some of these principles and some of these ideas that we've been benefited of or taken benefit of for the past hour from Fari Hamzei of Hamzei Analytics, and he is one of the top traders. And he's a TradeStation user. We're very happy that he spends time with us when he can. All right, so thanks very much, and let's have a great night.
You're quite welcome, guys. I'll leave you my email is admin@Hamzei Analytics. If you have any questions, you can always hit us. And if we were also more than happy to give you a little test drive. It's up to you. If you like, we're happy to. But here, actually, Hamzei Analytics. That's our email. Send us a note. Tell us you in this webinar. More than happy to get you into what our system does. And just that, be prepared to go through some training. Do some paper trading first. Okay. Thanks. Thank you and good night.